Welcome to Living Your Wealth Today and Tomorrow, the show where we explore how to enjoy the wealth you've already built, as well as how to best plan for a successful financial future. I'm your host, Kelly Ennis, founder and president of Infinity Financial Strategies. Welcome back to Living Your Wealth Today and Tomorrow. Today, we're tackling a topic that's both exciting and surprisingly complicated: the challenges of being a 401k millionaire. Now, when you hear that phrase, 401k millionaire, it sounds like a badge of honor. And in many ways, it is. Achieving $1 million balance in your retirement plan is no small feat. It represents years, if not decades, of consistency, persistence, and discipline. Think about it. Every paycheck, you've chosen to set aside money for tomorrow. You've resisted the temptation to spend every dollar today. You've weathered market ups and downs, and you've trusted that your future self deserves the gift of financial security. That kind of long-term thinking is rare, and it deserves real praise. So let's start by celebrating the achievement. If you've reached that 7-figure milestone in your 401k, 403b, or another employer retirement plan, you've demonstrated 3 incredibly valuable qualities: consistency, making contributions month after month; persistence, sticking with the plan through market downturns, job changes, and life's surprises; and vision, the ability to plan for tomorrow instead of focusing only on today. Those qualities alone set you apart. But here's the twist. Reaching that milestone isn't the end of the story. In fact, once you become a 401k millionaire, a new set of challenges emerges, and that's what we're going to explore today. It's important to note the things we talk about today generally apply to 403b, 457, and other employer plans as well. Now, before we dive into the challenges, let's talk about the good stuff. First, the 401k is still one of the most powerful retirement savings tools out there. It is often an easily accessible and mostly automated vehicle for saving for retirement. Your employer generally provides for enrollment when you're hired. In fact, in many cases, you'll be automatically enrolled when you start your job. And your contributions are made directly from your paycheck, so it is highly unlikely that you'll miss making contributions because the money is spent elsewhere. The second benefit is that employers often make contributions on your behalf. These may be matching contributions, which require you to make a contribution from your own pay in order to receive a contribution from your employer. Or, in some cases, they're non-discretionary contributions, where the employer simply contributes a certain percentage of your eligible compensation or even a flat dollar amount to your account, regardless of whether you are making contributions. And then there are profit-sharing contributions, where the employer can designate contributions to be made to employees' accounts each year based on company performance. Any of these types of contributions can help you build your retirement nest egg. The next benefit is tax deferral on contributions. Every dollar you contribute to a pre-tax 401k reduces your taxable income for that year. If you earn $150,000 and contribute $20,000 pre-tax, you're only taxed on $130,000. That's immediate savings on this year's tax bill. Another valuable benefit is tax-deferred growth. Not only do your contributions grow over time, but the earnings, the dividends, the interest, and capital gains aren't taxed as they build. So, for instance, if you sell $40,000 worth of a mutual fund in your 401k account and $20,000 of that was gain, you still have $40,000 to invest in other funds. Whereas if that $40,000 sale had occurred in your taxable brokerage account, you would have to account for the taxes that will be due on that $20,000 gain. Those taxes reduce the amount that you have left to invest. The tax deferral on the growth in your 401k account allows for compounding of more money, and that compounding can make a massive difference over decades. And then there's the Roth 401k, which offers a different type of tax advantage. With a Roth account, your contributions are made with after-tax dollars. That means no upfront tax savings, but in exchange, you get tax-free growth, meaning all of your money has the potential to keep on compounding. And more importantly, you have the opportunity for tax-free withdrawals in retirement if you meet the rules. Why is that such a big deal? Because Roth withdrawals don't show up in your adjusted gross income. That means They won't reduce your eligibility for certain deductions. They won't phase you out of valuable tax credits, and they won't push up income-related fees like Medicare's IRMAA surcharge. In other words, the Roth 401k gives you tax-free income in retirement without the collateral damage of making your tax return look bigger. Now, let's talk about where the challenges begin. Remember that traditional 401ks are tax deferral vehicles. They are a way to defer your compensation. When the concept of 401k plans was proposed, the idea was that they would allow a worker to defer part of their compensation until they were no longer working. In exchange for this deferral of income, the government would allow the employee to defer the taxes on the amount they contributed and any growth on that contribution until they withdrew it from the account. The thought was that these plans would be attractive because it was likely that the employee would be in a lower tax bracket in retirement and therefore ultimately pay less in taxes. But things have changed since then. 401k plans came out about the Revenue Act of 1978, and then they were really codified in 1981 when the IRS allowed employers to fund the employee 401k accounts directly through paycheck reductions. Now, in 1981, federal income tax rates ranged from 14% to 70%, and there were many more tax brackets. For instance, the first $3,400 was taxed at 0%. The next $2,100 was taxed at 14%. The next $2,100 were taxed at 16%. The next $4,300 were taxed at 18%, and so on. The brackets were narrow, so a joint return with $43,000 of taxable income would have had income in 10 different tax brackets. It was perfectly reasonable to think that most people would be in a lower marginal tax bracket when they retired. The combination of the sheer number of tax brackets with the loss of wages almost guaranteed that. There was the idea that there was a cost to having a job. Things like purchasing and maintaining a professional wardrobe and commuting daily to work. The thought was that a household wouldn't need as much income in retirement simply by eliminating these work-related expenses. You may have heard the notion that you could retire on 70% of your pre-retirement expenses from back then. Well, fast forward to today. Just the two examples I mentioned, the line between professional and casual wardrobes has blurred, and many people have lower commuting expenses since they can work from home at least part of the time. So there is the question about whether there really is a reduction in expenses at retirement. Spoiler alert, in my experience, there isn't an immediate reduction in expenses. 401k plans became widely offered by employers because they offered a much more predictable cost than pensions. With pensions, employers were on the hook to provide a defined benefit to their employees in retirement, a specific, calculable amount, regardless of economic conditions or investment returns. This is why pensions are also called defined benefit plans. In the case of poor investment returns for the pension plan, employers had to contribute more money to meet those obligations. On the other hand, 401k plans are defined contribution plans. The employee can contribute and the employer can contribute, and any amounts that are actually specified or defined are on the contribution side, not the benefit side. With defined contribution plans, the employer is no longer responsible to provide a defined benefit, only a defined contribution, which they can easily predict. So, 401k plans became widely offered and replaced pension plans in many companies. Due to the rules that apply to 401k plans to prevent them from being overly generous to highly compensated employees and owners compared to rank-and-file employees, it's in the plan sponsor's best interest to promote the plan and get participation from as many employees as possible. Over time, a 401k became a sought-after benefit, and then it just became table stakes for recruiting talent. The number of 401k plans skyrocketed and the balances in those plans soared. As a 401k millionaire, you are among the approximately 70 million people with a 401k account. You've probably had the benefit of tax deduction on your contributions, and you've likely had tax deferral on your investment returns for years. And your employer has likely contributed to your account to help you on your way to millionaire status. Here's where the problems of success come in. When you've accumulated a balance in a traditional 401k, you'll face something called required minimum distributions, or RMDs. RMDs are mandatory withdrawals the IRS requires once you reach a certain age, currently 73 for many people. The government has been very patient while you let that account grow tax deferred. Remember, when you make contributions to a traditional 401k, your taxes are deferred, not eliminated. And your account received contributions from your employer, which haven't been taxed yet. But at some point, the IRS wants their cut. So here's how the RMD works. Each year, the IRS looks at your account balance from the end of the previous year, then divides it by a life expectancy factor. That calculation determines how much you must withdraw, whether you need the money or not. For someone with $1 million traditional 401k today at RMD age, that first RMD might be in the neighborhood of $36,000 to $40,000. As you age, the percentage gets bigger. By your mid-80s, the required withdrawals can be very large, especially if your account continues to grow due to investment returns. Now, imagine you have 2 workers in the household with large 401k balances, which will be subject to RMDs. And if you're only 50 years old and already have $1 million 401k, if it grows at a modest 6% each year, you'll have at least $4 million by the time you have to start RMDs. And that's with no more contributions. So that $36,000 to $40,000 RMD we talked about for millionaires ready to take their RMDs now, it will be more like $150,000 for each of you. The challenge is this. Those forced withdrawals can push you into a higher tax bracket. They can also increase your Medicare premiums through IRMA, the income-related Medicare adjustment amount, and they can make you ineligible for tax credits or deductions you otherwise could have claimed. So it started as a celebration. I'm a 401k millionaire, can turn into a tax management puzzle in retirement. Another big challenge of the 401k is the loss of control. Investment options are often limited. You might have a menu of 15 or 20 mutual funds, and that's it. No real estate, no individual stocks, no private investments. For some investors, that is frustrating. The limited investment options in a 401k plan often make it difficult to have a holistic approach to portfolio management. Often, there are few or no funds in a particular sector or fund category, and sometimes the options are very expensive. The RMD challenge is another example of loss of control. You don't have much control over when income will be taken for tax purposes. You can take more than the RMD, but not less, or you'll be subject to hefty penalties. And not only will you be paying taxes on the RMD when you take it, even if you simply reinvest the funds in a regular taxable brokerage account, you have lost the tax-friendly nature of those dollars. The IRS just wasn't going to wait anymore. It's important to note here, Roth 401ks no longer have RMD requirements, so Roth 401k funds can keep on growing tax-free. Further loss of control, access to 401k funds is restricted. With very few exceptions, you can't touch the money before age 59 and a half without penalties. And if you're still working for the employer who sponsors the plan, you usually can't roll the money out, even if you'd prefer different investment choices or you realize that you already have enough for retirement savings. Access to the money in your 401k plan is so limited that 401k millionaires who have a great-looking balance sheet often can't afford their goals, like paying for college or buying a retirement home while they can still enjoy it with their family, because the bulk of their wealth is out of reach. So this is the case for strategic wealth planning. This is why I often say, your 401k should be a cornerstone of your wealth plan, but not the whole building. You shouldn't be waiting for your retirement for life to begin. Building wealth outside of your 401k gives you flexibility. A taxable brokerage account, for example, doesn't have contribution limits like a 401k does. You can invest as much as you want in the securities that make sense for you. And while you do pay taxes along the way, you also have complete access to those funds. That flexibility can be a game changer. Want to retire at 55? Funds in a taxable account can bridge the gap until 59 and a half. Need to pay for a child's college tuition? Taxable accounts give you options that 401ks don't. Want to purchase a vacation home before all the kids move away? You don't have restrictions on how or when you use money from a taxable account. While the 401k is often the default wealth-building vehicle simply because it happened behind the scenes, the contributions were deducted from your paycheck before you even saw the money, and The enrollment form, back when there were paper forms, was right next to your I-9 and your W-4 when you were hired. But now you know that there's more to the story. There's more you can do to ensure that your money is working towards all of your goals, not just the generic retirement goal that the government and your employer assumed would be your primary goal. So, what can you do if you're a 401k millionaire? First, continue with your consistency, persistence, and vision. It's brought you this far and can help you in the pursuit of many financial and life goals. Then, take a step back and determine how your 401k account fits into your overall financial picture. What role does it play in reaching your goals? Will you be able to meet your short-term goals, or will you have to wait until retirement to be able to consider financial expenditures? You've heard the term house poor, when people spend all their money on purchasing the house and don't have any left to furnish the house. There's also retirement poor, people who have large sums of money locked up in their retirement accounts but struggle to meet their current goals. Do you have a lifetime strategy for minimizing taxes and maximizing the amount of income you get to keep? Without having multiple potential sources of income, like Roth accounts and taxable accounts in addition to your pre-tax accounts, the strategies available to you to manage your income taxes in the future may be limited. Your primary strategy may come down to simply varying the amount of income you take each year, rather than determining the best combination of income sources to make up your desired income. You may determine that you need to build more income and investment options both for now and for the future. Because one of the most important objectives of a financial plan is to ensure that you have options, so that your resources can be ready when you are, regardless of what you decide to pursue. So, for specific steps that you can take, determine where your 401k account fits in your overall plan. Yes, it's for retirement, but there are further questions, like when in retirement, early or mid or late? Is it intended as your primary source of income from the day you retire, or maybe not until RMDs are forced? Do you have other sources of income? When do 401k withdrawals fit alongside Social Security payments? Once you answer these questions, and as you get closer to retirement, what is the real time horizon you should be using when choosing your investment mix? Once you know what role it should play, you can determine how much, if any, should continue to be funneled into your 401k account from your paychecks. And remember to consider your broad financial picture when making these decisions. Reducing your current pre-tax 401k contributions will not only subject additional funds to income taxes this year, it might also affect your eligibility for certain deductions and credits this year. So be sure to consider changes in context of the big picture, both your current situation and your anticipated future situation. To some degree, there will be a trade-off between what you know taxes are now and what you think they'll be in the future. A situation of the devil you know versus the devil you don't. And if you determine that it's time to shift your wealth-building cash flows from 401k contributions to taxable investment account contributions, do some further self-examination. If you know that the reason you've been able to build this wealth is because the deposits were automated, then continue with the automation. Many employers allow direct deposit of net pay into outside investment accounts. And in the case that your options for direct deposit are limited, you can likely set up automatic transfers from your bank account to your investment account. This automation gives you one fewer task to remember with every paycheck. And you'll also want to remember to automate the investing once the money is in your investment account. So, let's bring it all together. Becoming a 401k millionaire is absolutely worth celebrating. It represents discipline, persistence, and vision. It shows you've made smart choices for your future. But it also comes with challenges. Required minimum distributions, potentially higher taxes, Medicare surcharges, limited investment options, and restricted access to your funds. The key is balance. Your 401k should be an important piece of your financial puzzle, but it shouldn't be the only piece. Building wealth across different asset types and multiple account types, pre-tax, Roth, and taxable, gives you the flexibility and control you need to truly thrive in retirement. At the end of the day, wealth isn't just about numbers on a statement. It's about freedom. Freedom to retire on your terms, to help your family, and to enjoy the life that you've been working toward all these years. Thanks for joining me today. If you enjoyed this episode, share it with a friend who's on their own path to retirement. And remember, becoming a 401k millionaire is a milestone, but the real victory is building a flexible, sustainable plan for the future. Thanks for listening to this episode of Living Your Wealth Today and Tomorrow. This podcast is for educational and informational purposes only. It is not tax, legal, or investment advice. Seek guidance from your legal and financial professionals before acting. For more insights on planning for your financial future, follow me on LinkedIn. And for more information on Infinity Financial Strategies, visit our website at infinityfinancialstrategies.net. If you enjoyed the show, please share it with a friend or family member who might benefit from listening, and please leave a review wherever you listen. Tune in next time for more tips and tricks on living your best life through financial planning.